Warren Buffett built one of the greatest investment records in history by deliberately not owning what reshaped the modern world. No obsession with innovation cycles, no chase for technological dominance, no belief that disruption automatically creates value. While Silicon Valley sold the future, Buffett kept buying the present, and somehow, year after year, decade after decade, he still won. This isn't about fear of technology. It's about fear of something far more permanent, irreversible capital loss. And this is dark alpha, where value meets velocity. Right now, technology is not just a sector. It is the dominant narrative of capital allocation. Capital flows where belief concentrates, and belief today overwhelmingly favors speed, scale, and software. Investors are taught that missing the next technological wave is the real risk, that standing still is fatal, that if you don't understand AI, cloud infrastructure, or platform economics, you are already obsolete. But here's the uncomfortable truth. The same forces that create exponential upside in technology also create irreversible downside. Not volatility, not drawdowns, but permanent impairment of capital. Buffett understood something most modern investors are trained to ignore. When the future is uncertain, precision matters more than potential. This topic matters because the market is no longer asking, "What is this business worth?" It is asking, "How big could this become?" That shift changes everything. If you misunderstand why Buffett avoided technology for most of his career, you risk misunderstanding risk itself. You risk mistaking optionality for durability and momentum for protection. This is not about copying Buffett. It's about understanding the invisible cost of being wrong when the business you own has no margin for error. If you don't understand this, you're not just missing a style preference. You're missing a structural insight about how capital survives across time. Warren Buffett did not avoid technology because he disliked innovation. He avoided it because he distrusted fragility. To understand this, you have to temporarily forget stock tickers and earnings calls. You have to think in terms of business permanence. Buffett's entire framework rests on one quiet question. How certain am I that this business will still matter in roughly the same way 10, 20, 30 years from now? Not bigger, not more exciting, but recognizable. Technology businesses rarely meet that standard, not because they fail more often, though many do, but because success itself attracts destabilizing forces. Competition accelerates. Innovation compresses margins. Customer loyalty becomes conditional. In most industries, dominance decays slowly. In technology, dominance decays abruptly. This isn't a moral judgment, it's a structural reality. Buffett came of age in a capital market shaped by tangible economics: railroads, insurance, consumer goods, energy. Businesses where competitive advantage was built through distribution, regulation, brand, or physical scale. Moats that eroded over decades, not quarters. Technology, by contrast, runs on abstraction. Code replaces concrete. Networks replace factories. Speed replaces scarcity. That abstraction makes growth extraordinary, but it also makes forecasting unreliable. Buffett's edge was never prediction. It was elimination. He eliminated businesses where too many variables could go wrong at once. He eliminated industries where the future depended on staying ahead of unknown competitors. He eliminated models where success required continuous reinvention just to stand still. This wasn't conservatism, it was selectivity. Because in Buffett's framework, capital loss is asymmetrical. You can recover from missed opportunities. You cannot recover from owning a business that permanently breaks. This context matters because modern markets reward exposure, not endurance. And Buffett's philosophy was built entirely around endurance. The dominant idea is simple, but deeply misunderstood. Buffett avoided technology because technology compresses the margin of safety to near zero. Margin of safety is not about valuation multiples. It is about structural forgiveness. A business with a wide margin of safety can survive management mistakes, economic shocks, and competitive pressure. A business without it cannot. Technology businesses operate on narrow ledges. They depend on continued relevance, sustained user behavior, defensible intellectual advantage, constant capital reinvestment. Miss any one of these, and the entire structure weakens. Buffett did not want to invest where survival depended on perpetual excellence. Consider the difference between a consumer staple and a software platform. A consumer staple can underinvest for years and still generate cash. Customers may complain, but they rarely abandon overnight. A technology platform, however, exists in a competitive knife fight. Users are loyal until they aren't. Switching costs feel high until a better alternative appears. This is where Buffett diverged sharply from modern tech optimism. The market often assumes technological leadership compounds naturally. Buffett assumed it attracts predators. Every dominant technology business creates incentives for disruption. Every margin invites erosion. Every standard invites replacement. This doesn't mean tech companies can't be great investments. It means the confidence interval around their future cash flows is wider. Buffett disliked wide confidence intervals. He preferred businesses where the future was boring. Predictable demand, stable pricing power, incremental change, because boring futures are easier to insure against. Now here's the reframing moment most people miss. Buffett was not avoiding growth. He was avoiding fragile growth. Growth that depends on staying ahead. Growth that collapses if leadership slips. Growth that is real, but not resilient. Technology often produces exactly that. Take the history of dominant tech firms. For every survivor, there are dozens of fallen leaders. Not because they were poorly run, but because the terrain shifted beneath them. Buffett didn't believe he could reliably predict which technologies would persist. And more importantly, he didn't believe he needed to. His model did not require capturing the future. It required surviving it. There's a subtle but critical distinction here. Most investors optimize for upside capture. Buffett optimized for downside avoidance. Technology excels at upside. It struggles with protection, and protection is what allows capital to compound quietly over time. This is why Buffett famously said he didn't want to invest in businesses he didn't understand. Not because he lacked intelligence, but because understanding to him meant being able to bound the downside. If you cannot estimate the range of failure, you cannot price risk. Technology resists bounding. The mini-twist is this. Buffett's avoidance of tech wasn't about skepticism of innovation. It was about respect for uncertainty. And uncertainty, when mispriced, is lethal to long-term capital. Now introduce the counterweight. If Buffett represents defense, then figures like Elon Musk represent offense, not recklessness, but deliberate exposure to technological uncertainty. Musk builds businesses that require constant reinvention. Tesla, SpaceX, Neuralink. These are not protected by static moats. They are protected by velocity. Speed replaces stability. Execution replaces predictability. Where Buffett avoids fragility, Musk embraces controlled instability. This contrast is essential. Buffett's model assumes capital should outlive individuals. Musk's model assumes individuals can bend timelines. One optimizes for permanence, the other for acceleration. Neither is inherently superior. They simply price risk differently. Buffett believes markets overpay for narratives of inevitability. Musk believes markets underprice what is technically possible. Here's the trade-off. Buffett's avoidance of technology limits upside during periods of rapid innovation. Musk's embrace of technology exposes capital to existential failure. Buffett trades magnitude for survivability. Musk trades survivability for magnitude. Technology rewards those who move first and punish those who hesitate. Value investing rewards those who wait and punishes those who chase. The key difference lies in control. Buffett prefers businesses where outcomes are shaped by structure. Musk builds businesses where outcomes are shaped by will. One trusts systems, the other trusts execution, and markets alternate between rewarding each. The danger arises when investors confuse one model for the other. when defensive capital is deployed into offensive terrain, or when offensive ambition is financed with defensive expectations. Buffett avoided technology because it required a mindset he refused to adopt, a willingness to be wrong spectacularly. He did not want to compete in arenas where second place meant irrelevance. This is why even when Buffett eventually invested in Apple, it was not framed as a tech company. It was framed as a consumer ecosystem with brand loyalty approaching habit. That distinction mattered. He waited until technology behaved like a consumer staple, until it slowed, until it stabilized, until its ecosystem hardened. Again, not ignorance, timing. If Buffett's model works, capital compounds quietly. Drawdowns are survivable. Mistakes are recoverable. Investors avoid catastrophic loss at the expense of missing extremes. The system rewards patience. It reinforces incumbency. It favors businesses that age well. But if this model fails, it fails by stagnation, by irrelevance, by watching transformative shifts pass by. Now consider the opposite. If the technology-first model works, wealth concentrates rapidly. Winners dominate markets. Capital reallocates aggressively toward innovation. But if it fails, losses are not gradual. They are sudden, permanent. This creates a structural divide in capitalism. Defensive capital seeks durability. Offensive capital seeks dominance. Both influence capital allocation decisions across the economy. Where money flows determines what gets built and what doesn't. Buffett's philosophy supports incremental progress. Technology-first capital fuels discontinuity. The question is not which is morally better. The question is which risks society and investors are willing to absorb. As technology accelerates, Buffett's caution becomes rarer, but also more valuable. Because in a world obsessed with speed, resilience becomes scarce. The implication is uncomfortable. Future markets may reward those who can tolerate uncertainty, but punish those who cannot survive it. Buffett's legacy is not about returns, it's about time. He optimized capital to endure long enough for probability to work in his favor. That is a structural insight, not a stylistic one. Warren Buffett didn't avoid technology because he underestimated it. He avoided it because he understood something deeper about capital's relationship with time. Capital doesn't need to be brilliant, it needs to be alive. Every era creates its own definition of intelligence. Today, intelligence is speed, adaptation, technical fluency. But intelligence without durability is noise. The unresolved tension is this. As technology continues to reshape every industry, the space for businesses that don't change may shrink. And yet, the value of stability may rise precisely because it is rare. So the question isn't whether Buffett was right or wrong. The question is whether the future belongs to those who can move fastest, or to those who can afford to wait the longest. And whether capital, once again, is confusing progress with protection.